Financial reporting in times of crisis. The process of financial reporting undergoes significant challenges during economic crises, such as the COVID-19 pandemic. These situations demand that companies adapt their reporting methods to reflect the unique financial environment they face. Here's a detailed breakdown of the key aspects of financial reporting during crises. 1. Asset valuation adjustments. Impairment testing. During crises, assets such as property, equipment, and intangible assets may lose value. Companies need to perform impairment tests to determine whether the carrying amount of an asset exceeds its recoverable amount. If an asset is impaired, the loss must be reflected in the financial statements. Fair value adjustments. In volatile markets, fair value measurements can fluctuate significantly. Companies should re-evaluate how they measure assets and liabilities at fair value, ensuring compliance with the latest accounting standards like IFRS 13 or ASC 820. 2. Revenue recognition. Contract modifications. In times of economic downturn, companies may face renegotiations or modifications to their existing contracts with customers. They must reassess how revenue is recognized according to the changes in contract terms, such as delivery delays, cancellations, or extended payment periods. Uncertain cash flows. Companies need to evaluate the collectibility of revenues, especially if customers are struggling financially. Expected credit losses and potential uncollectible accounts should be accounted for in the financial reports. 3. Liabilities and provisions. Increased provisions. During crises, companies may face additional liabilities, such as restructuring costs, employee layoffs, or legal claims. Provisions for these costs must be recognized in the financial statements if they are probable and can be reasonably estimated. Debt restructuring. Many companies may renegotiate their debt agreements, leading to the modification of loan terms. These changes should be reflected in the company's financial liabilities, and any resulting gains or losses must be reported. 4. Going concern assumption. Evaluation of continuity. One of the most crucial aspects of financial reporting during a crisis is assessing the company's ability to continue as a going concern. If management believes that the company may not be able to meet its obligations for the foreseeable future, this uncertainty must be disclosed. The financial statements may need to be prepared using a different basis, e.g., liquidation basis, if the company is no longer a going concern. 5. Disclosure requirements. Detailed risk disclosures. Companies are required to provide more detailed disclosures on the risks they face during a crisis. This includes liquidity risks, market volatility, and credit risks. Investors and stakeholders demand transparency to better understand how the crisis is affecting the business. Impact of government support. In cases like the COVID-19 pandemic, where governments offered relief packages, loans, grants, tax deferrals, companies must disclose the nature and extent of such assistance in their financial reports. Any related obligations or contingencies must also be included. 6. Liquidity and cash flow management. Enhanced focus on liquidity. In times of financial crisis, cash flow becomes a critical concern. Companies should emphasize liquidity reporting, including clear disclosure of available credit lines, cash reserves, and any liquidity stress the business is facing. Scenario planning and sensitivity analysis. Many companies turn to scenario planning to better understand how different crisis scenarios could impact their cash flows, debt covenants, and overall liquidity position. This analysis can also be disclosed to provide stakeholders with a clearer picture of potential risks. 7. Revised forecasts and guidance. Updating earnings forecasts. Companies must adjust their earnings forecasts to reflect the current economic environment. This may involve revising profit margins, cost structures, and revenue projections. Withdrawing or modifying forward-looking statements. Some companies may choose to withdraw previous guidance if the future becomes too uncertain to predict accurately. These decisions must be clearly communicated to stakeholders, along with reasons for the withdrawal. 8. Tax considerations. Deferred tax assets and liabilities. A crisis can affect a company's tax position, especially with regard to deferred tax assets and liabilities. Companies should assess whether they can still realize deferred tax assets or if changes in tax law, e.g., government relief programs, impact their tax provisions. Tax loss carrybacks and credits. Companies should review available tax loss carryback provisions or credits, which can provide immediate cash flow benefits during economic downturns. 9. Cost management and expense reporting. Expense prioritization. In a crisis, companies often reassess their cost structure, cutting unnecessary expenditures to conserve cash. This may include workforce reductions, deferral of capital expenditures, and renegotiating contracts with suppliers. Restructuring costs. Companies incurring restructuring costs due to layoffs or operational changes must ensure these costs are accurately reflected in financial statements. 10. Communicating with stakeholders. Transparent and frequent updates. During crises, clear and regular communication with investors, creditors, and other stakeholders is essential. THIS includes providing updates on financial performance, liquidity, and any significant risks or uncertainties the company faces. Investor confidence. Transparent communication helps maintain investor confidence, even in difficult times. Companies that proactively address the challenges they face and the steps they are taking to mitigate those risks tend to fare better in market perception. Financial reporting during times of crisis, such as the COVID-19 pandemic, requires heightened diligence and adaptability. Companies must ensure that their financial statements provide an accurate and fair representation of their financial position and performance, while also disclosing the full impact of the crisis on their business. Key areas of focus include asset valuation, revenue recognition, liquidity management, and risk disclosures. Additionally, companies must communicate openly with stakeholders to maintain trust and demonstrate resilience in the face of adversity.